All right. In 3, 2, 1. All right. Let's get started. Let's kick it off right now. Who is your hero?
I would have to say it would be my mom.
Oh, love it. I think my mom's my hero too. You know, moms are always there for us, right?
Yeah. Yeah. She's like multitude of just like cheerleading, like mom, best friend. So she's definitely the person I look up to.
All right. Mom's my hero too. All right. If you could live anywhere, where would it be?
Here, Ventura.
Ventura, throwing it out here. Yes, we have beautiful weather, 310 days of sunshine.
And it's dog friendly.
It is dog friendly. Yes, it is.
Yeah.
What is your biggest fear?
Rats.
Yes, I'm going to go with that one too. What is your favorite vacation?
Like place?
Sure.
I love Chicago.
Chicago. I have not been to Chicago, so I need to add it to the list.
Yeah, it's awesome restaurants, great nightlife.
Okay.
Love it.
I'm a big foodie. You had me at food. Okay. What would you change about yourself if you could?
I would be a little taller.
Okay. All right. What makes you really angry?
When people are not on top of their like obligations, like if I have to follow up too many times.
Yes, I gotcha. Yeah, the babysitting, that's not fun. What motivates you to work hard?
My family.
There we go.
I want to make them proud.
It's coming through, true and true. You are a family gal. I love it. All right. What is your favorite thing about your career?
I love how my company believes in me.
Ooh, that's huge. That's company culture. That's, feeling proud to work for who you work with.
I love how they just let me be authentically me.
I like that. And I can relate to that. So that is awesome. What is your biggest complaint about your job? Shh, we won't tell your boss.
It doesn't have to do with like my actual employer. It'd be more so my customers. Sometimes I feel like it's hard to get in contact with them, and it just becomes challenging to establish a partnership. So that can be very, very frustrating.
Gotcha. Getting in the door. Got it. Okay, what is your proudest accomplishment?
Buying a house.
Awesome.
All on my own.
There we go. That is very awesome. What is your favorite book?
How to set boundaries. I don't know if that's the title exactly, but it's all about boundaries.
Okay. All right. What makes you laugh the most?
Someone who's funny.
Okay. What was the last movie, not that you saw, but that you went to?
That I went to? It was that Bears movie that just came out recently.
The Cocaine Bears?
It was stupid.
It is based upon a true-ish story.
Really?
Yeah, it was.
It was just a weird movie. We only went to kill time.
It was very gory.
Yeah.
Yeah.
I wasn't a fan, but I watched
Okay.
it.
All right. Mine was Super Mario Brothers. So
Oh, I did watch that one.
can you tell I have children?
Yeah.
Right.
I watched that one too. I don't have kids.
Yeah. All right. What did you want to be when you were small?
I wanted to be a writer.
Okay. If you could do anything for a day, what would it be?
I would sleep in, definitely.
Yes.
And I would go to a nice coffee shop.
Okay.
I would have brunch. I would go shopping. And then maybe go to a nice restaurant.
Sounds like
All
Chicago is in
food-related.
your future
Yeah.
for sure, right?
Yeah.
Okay. What's your favorite game or sport to watch or play?
Baseball.
And you just asked me if I like the Dodgers. I'm going to flip that back on you. Are you a Dodger gal?
I am a Dodger gal, but
Okay.
I would prefer the Cubs.
Chicago's in your future. I
Yeah.
see it. All right. Would you rather ride a bike, ride a horse, or drive a car?
Drive a car. I don't know how to ride a bike.
Okay. What?
I don't.
What?
I don't.
As much as you praise mom, I love her. She's my hero too. Mom needed to teach you how to ride a bike.
She actually bought me a bike, and my dad sold it.
Okay. All right. I won't inquire anymore. If you were to sing a karaoke night, what would you sing?
I wouldn't sing. I'm not talented like that.
Okay. And which would you rather do? Wash dishes, mow the lawn, clean the bathroom, or vacuum the house? I'm going to go with none of those. Those are all terrible.
I know.
Yeah, let's just move on.
I mean, all of them, they need to get done.
Right? All right. Well, welcome today. Today, I have a wonderful guest. I have Jocelyn Vasquez. She is an account manager with MGIC. Not everybody maybe knows that company, but if you work in the industry, you absolutely do. But she works for a mortgage insurance company. So we've got lots of questions for her today. Welcome, welcome.
Thank you. Thank you for having me.
Of course. No, when you came into my office the other day, and this is kind of my intro, why did I do all of these questions? Is I'm just getting to know Jocelyn myself. There's a lot of office visitors that we get at times. Some don't go well, some are cheesy, some are this, some are that. And it's, you came in with the right attitude, the right smile, the right answers. And I just said, do you want to be on my podcast? And you said, yes. And that was the winning answer. So here we are.
You caught me on a good day.
Yeah, well, again, this is G Money, real talk on everything mortgages and real estate. And what I really like to do is not just talk loan programs, right? But anything, upcoming, we've got a plumber coming in here to talk about the sewer lateral and some of the inspection requirements. But as we go through the mortgage process, these are the topics and things that we want to discuss. And we want to give our listeners, our viewers, information, valuable information, a much deeper dive than just a few minute consultation on the phone or whatnot. And so, I constantly hear mortgage insurance and a client scoff or roll their eyes. And my response is always, you know what? You may not like paying it, but without it, you wouldn't have a home. And so to me, that is just a huge win that we do have products available like mortgage insurance. And let me just kind of give you the history is traditionally, many, many moons ago, before I got into the industry, you had to have 20% down. And to promote home ownership, it is one of that double-edged sword of, yes, one of the big requirements is capital, cash, and it takes a while to save that. And so with less money down, it will promote home ownership, but obviously it becomes risky, and it becomes risky for the lenders. And so it was a trade-off. The lenders said, hey, if you're willing to pay for this insurance premium that protects you against any loss, default, whatever, then absolutely we're willing to give you a mortgage. And that's where mortgage insurance steps in. For government programs, I want to make this disclaimer up front, those are self-funded. So if we're talking about a USDA, a VA, or an FHA loan, all of those premiums are payable to either the VA or HUD, et cetera. So when it comes to conventional loans, this is Fannie, Freddie, conventional conforming, high balance loans, then we can choose. And competition is good, right? Because it helps us keep the premiums down and really become more competitive. We can choose which companies to obtain quotes from and which companies to provide those services for our clients' loans. Being honest, competition really kind of keeps an even playing field. I don't think, we'll get into, you may have a few little nuances that another one does, another company may not have, and vice versa. But it's not that you're the only company that insures it up to 95% or 97%, right? It kind of keeps a nice little regulation there, just like mortgage companies. So I'm not trying to take away from that, but that's what mortgage insurance is and does. And so it's nice to have a relationship with our reps. So as we are doing loans as an originator, of course we know what we're doing, but at the same time, it's good to have these little nuances where some companies are a little bit better premium, and not just shopping on premium. We actually have some tools and some things up our sleeve today to share with you about some things that MGIC does have. So without further ado, Jocelyn, I want to hear from you. So let's kind of get started on the intro of mortgage insurance, and tell us what you can.
Yeah, so I'd like to point out that MGIC, the company that I work for, we are actually the pioneers of the mortgage insurance industry.
Oh, wow.
So 66 years ago, our founder actually was the reason that mortgage insurance now exists.
Okay.
Prior to us, there was no mortgage insurance business. So
love it.
MGIC started this industry, and I love working for them for that reason, as well as they're just an amazing company. But yes, there are other competitors, as you said. And what we pride ourselves in is truly not only giving you a premium, but also building a partnership. Like, we're here to support you to get leads, to help educate consumers, help spread, education, awareness, seminars. We have tons of tools that we give you to be able to differentiate ourselves and truly earn that business. Because as you pointed out, there's many others that you can shop, but we truly try to differentiate ourselves and try to, earn that business, because at the end of the day, it's very competitive. And sometimes, we may not be the lowest, but we also may not be that much off where you can't send us a deal. And I know, and this is just something I always tell people, that we don't always buy stuff just because it's cheaper.
Right.
We want to buy stuff that's quality, and we always are okay with paying a little bit more. So if I am a little bit more, I would hope that, would still send the business my way because of our partnership.
Right. Absolutely. And, and we're going to get more detailed down the road here on this choice program, which is exclusive to you guys. And, kind of with that, you can kind of dial in the premium to where you want it. So, this is maybe a little bit of an ace in your back pocket of catering the mortgage insurance premiums to what suits the client's needs.
Exactly.
Now, what I'm going to kind of chat with here is, I get frequently questions of, what's the best loan for me? And so I'm just going to say in general, one, we want to see the full application with documentation, and it's not just me prejudging. When a client comes to me, I keep my eyes wide open, and they may qualify for an FHA loan, a USDA loan, and a conventional loan. But how do we know what's the best fit for them? And so it gets a lot more technical of, asking questions. What are their goals? How long-term they are into the home, et cetera, et cetera. Making just some blanket statements, I will state, though, up front, if you have lower credit scores, historically, going with a government-type product is probably a better fit for you. And the reason for that is the FHA, for example. FHA is one of the largest programs. It's been around for a long time. It's operated by HUD, the Housing and Urban Development. Again, they self-fund their premiums, but their premium is a flat rate. So it doesn't matter if you have a 620 score, a 580 score, a 780 score. So if you're listening to me correctly, the risk of credit score is really delineated. And so where do we find that really advantageous is on the low to moderate credit score spectrum. When we get into, I'd say, probably starting point of a 700 or greater, this is really where the conventional products, programs start to shine. And this is where we start to really evaluate, does it make more sense to go with a conventional loan? Now, ultimately, we always want to transition long-term into a conventional loan, because with that, mortgage insurance premiums at some point will go away. We're going to talk more detailed about how to remove them, et cetera. But for government programs, especially now with FHA 30-year loans, the mortgage insurance is there for the 30 years. Now, it's declining in nature, so the premiums go down every 12 months. I'm not going to get too detailed into FHA loans today, but I just want to compare and contrast, because today our topic is probably going to be, for the most part, 700 credit score borrowers that are interested in conventional products that will have private mortgage insurance. So with that, as we get into a 700 credit score, the premium that, again, people are just astounded. Oh, I don't want to pay mortgage insurance or PMI, whatever acronym, MI, PMI, that's private mortgage insurance. These are acronyms to the industry. Whatever you want to call it, as you have a higher credit score, it is a tiered premium, meaning you will have incentives, you will have lower premiums the higher your credit score. Additionally, it's tiered that the lower the loan to value, those premiums also decline in nature. So where some people come in and they think it's going to be $500 a month for PMI, if you have good credit score and you're putting 5 or maybe even 10% down, that premium may be $100 a month. And so, a lot of times people want to save that 20%, and it's just like the cost of waiting will far exceed that. When you look at, and I'm going to go off on my tangent because I'm always that guy that says, if you know that you're going to buy now. The longer that you wait to purchase, it's only going to cost you more. The appreciation in Ventura is averaging about 6% per year. This next year, it's forecasted at almost 8%, 7.65%. So if you wait 1 year, you wait a half a year, you're going to pay, could be $50,000 more for that home. And can you save up the differential in savings? I'm going to challenge you that you probably can't. And so if you can get started with a home with PMI, the sooner you can get into that home, just do it. I mean, my first home that I ever purchased, 3% down. I went with an MI conventional product.
Nice.
So
Me too.
Yeah. And it's one of those, like, don't be shy. Don't be embarrassed that you're putting lower amounts down. It's just, that's what the product is there for. It's to get you into a home.
I always tell people it's a strategy.
Yes.
Don't be shy about mortgage insurance. Don't follow all the herd that's saying, hey, avoid mortgage insurance. That is something of the past. We have become so affordable, especially in the last decade or two, to the point where, like you said, if you have good credit and you're a good standing bar, you can easily get a premium at like $100 a month. When I purchased my first home, it was easily $200 a month. When I purchased my second home, it was $100 a month. So, my credit got better. I was able to put down more. So I was able to get a lower premium, and I was able to keep 20 or 5%, about $20,000 in my pocket, instead of putting that additional 5% to complete the 20% down.
Sure.
So it's a strategy that people don't think about because they think it's going to be more expensive, but it's not. And like how you said, the difference between FHA and private mortgage insurance, I get that question all the time. People always think it's the same thing. It's not. And the biggest difference between FHA and conventional is the fact that FHA requires an upfront cost.
Yes.
You automatically have to pay 1.75 of whatever the purchase price is on that loan as a borrower when you're taking an FHA loan. Versus a conventional, we don't require anything upfront.
Right.
So right off the bat, you're saving money with us.
Right.
All you have to do is have good credit, have a good down payment. But granted, we go as low as 620. So
Right.
if you have a FICO of 620, you still can go conventional.
Right.
And a lot of times, especially in today's market, sellers don't want an FHA buyer. So if you know these tips, tricks, then you're able to structure yourself into a loan, a conventional loan, and be able to just be that much stronger when you submit your offers.
Right. And, it's not just what's the best loan for me. I alluded that earlier. Part of it is it does get into the details, the nuances of that. Just because you have a 620 score, yes, I'm highly interested in recommending an FHA, but let's just throw it out there. FHA is heavy into California as a community property state. And so what does that mean is if you're married, you can apply by yourself, but we also have to have a credit report on your significant other, on your spouse, and we take those liabilities into consideration. So qualifying can be a little bit tougher by yourself in those scenarios. So that right there is a perfect example of maybe, yes, we could have saved a few bucks mortgage insurance wise on the FHA, but on the conventional, when you're in California, you could be married, apply by yourself, and we do not need a credit report. And so that definitely simplifies things and maybe a reason that the directive is to go with a conventional loan with PMI.
Right.
And then just, again, to elaborate of what she was mentioning, the 1.75%, FHA specifically has a split premium. They call it, well, VA calls it the funding fee, but it is the upfront mortgage insurance versus monthly. And so upfront, they take your loan amount and they multiply that by 1.75%. So think about that. Almost 2% is a fee, a one-time fee that you're being charged to utilize that loan program. Because it is almost 2%, they do allow you to finance it. So it gets added on to your loan amount. So it does get a little bit confusing that you put a minimum of 3.5% down, but then if you do the math, and I'll just do an example here, you're buying a $100,000 home. Don't we all wish, right? 3.5% down would be $3,500. Your loan amount is not $96,500. You would need to add 1.75 or $1,750 onto that 96.5. So there's the fee. Not only do they charge the upfront fee, that's what they consider that, they also charge the monthly fee. The monthly fee varies by the loan term. So it's a different premium for a 15-year, for a 30-year, and also how much money you're putting down. So it gets a little bit technical, but not too bad with the FHA.
And it stays for the remainder of your loan term.
It does. And so I, again, said that it was declining. So once every 12 months, the premium will go down a few dollars based upon your remaining balance. But that premium is there for all 360 months, all 30 years, all 360 payments. So again, why do we want to transition to the conventional is because that can be removed. Now, before we get into removal, let's start talking about like actual MI premiums. I'm going to let you go, and let's start out with what people are most familiar with. They're most familiar with a monthly premium.
Right.
So, the acronyms of...
So we have 4 different premium plans, just so everyone out there knows. There's 4 different ways that you can pay for mortgage insurance. The one that's the most popular that most people tend to default to is our borrower paid monthly premium plan.
Yep.
So that you make a payment each month for your mortgage loan, and that includes your monthly MI payment. That's the most popular one. The second one is one that you're a fan of, and so am I, is the BPMI single premium. So that is basically like, for example, if you go out and you get a insurance for a car, they give you a full insurance premium. They tell you for the next 6 months, you're going to pay us $500 for your vehicle. Same concept. We give you a premium, a lump sum premium, and that's all that you have to pay for mortgage insurance. And if you have the money, if it's a $3,000 premium and you have that extra $3,000, you can buy out the whole MI. So that's single premiums. Also, a lot of people are not aware, you can finance single premiums. So you can even take that $3,000 in that example, and you can roll it into the loan amount, and you can have no mortgage insurance on your payment. Yep. So that's a great way to get the lowest payment possible because you're not paying on it monthly. And then the third one is what we just rolled out this year, which is called Choice Monthly. And Choice Monthly is where you get, as the buyer, the choice to determine how much do you want to pay up front on that mortgage insurance to reduce your monthly payment. So say your mortgage insurance monthly would be $150, but you want to reduce that. You want it to be closer to $100. Then you as the loan officer can give them that option, and you can play around with the numbers and see how much does that borrower need to pay up front to reduce that mortgage insurance premium to $100.
Right. And I know that you brought some examples. Let's give some real life examples of some premiums if we could.
Right. So I just did this morning. I took a $700,000 purchase price, putting down 15% as a down payment. And it was two borrowers, and husband and wife, let's say, and they both had 700 FICO scores.
Okay.
And I plugged in that information, and they also had, I put that they had a debt to income ratio of 30/40. So very decent debt to income ratio. And it automatically told me if they were going to do a monthly, then they're looking at $87.50.
$87.50 on a $700,000 purchase.
Yes, super affordable.
Absolutely.
But say they're like, hey, I still want it to be lower. Again, they can default to our choice monthly, and they can pay $1,960 and reduce their monthly payment to $35. $35.
Right. So
it's like less than dinner.
you get basically a significant discount. So you could buy it out completely, and we'll get to that, or you can do $2,000 up front and get your monthly down to $35.
Correct. Or you can do the third option, which is our single premium, and that would be, in this example, $3,430.
So you pay that one time, and you do not have monthly mortgage insurance. So what does this do? A lot of things. One, it does cost you more upfront, but as she mentioned, it is financeable. It is a sliding scale based upon factors, right? Loan to value, credit score, etc. So premiums can be higher, they could be lower. She's just kind of going mid-range here. But here's what it's doing is, especially when rates are higher, this is a leg up to get your payment down, right? It helps the affordability, right? So your buying power is increased because you don't have this premium that could be in FHA on a $700,000 purchase. That could be $300-$400 a month easy for their premiums. So it's something definitely that I love. And whenever I get the opportunity to educate people about the single premium, I do it. And it has saved me some loans, and people have gotten into homes because of the single premium, not just mortgage insurance in general, but because of that feature, it's really helped save a few deals.
And especially in today's market, buyers want the lowest payment. We get that. There's nothing we can do about the interest rates. But if your agent negotiates a seller concession of, say, $3,000 in this case, instead of applying that towards your closing costs, which, yes, it's great because you'll bring in $3,000 less at the end of the day when you're about to close, but that's not going to affect your payment.
Right.
If you use that, again, it's a strategy. If you use that $3,000 seller concession towards the MI, then you would have an $87 less payment.
The return on the investment is huge. Now, again, everything's scenario by scenario. I know as an industry professional, I have a login for this. Do individual consumers, or do they have to go through me?
They have to go through you. And specifically Choice Monthly is because it's something new. It is something that we're still getting approved nationwide, but American Pacific is one of our partners that already has approved it, so you do have access to that one already.
Wow, another ace in the back pocket. I love it. Yeah. So any of you listening that want to have some of these scenarios ran, I'll gladly help you out. We can talk through. I can get you some quotes, show you how that pencils out for your particular situation. And again, everybody's situation is different, but wow, what a great thing to learn. I'm loving the choice. I just met Jocelyn the other day. She brought it up to me. I had a client presentation yesterday. Absolutely did I bring that up, and were the clients excited about it. So thank you so much.
And the last plan that I do want to mention, because I said there was 4 and I want to just be 100%, we do have a 4th option, and that's lender paid mortgage insurance. However, I'll just kind of cover that one. That's not something that I would suggest in today's market, just because how it's paid is the premium would get rolled into the interest rate. Correct. Therefore, your interest rate would be higher. So it's just something that I'm not seeing in today's market, but you never know, might come back.
Yeah. I'll slightly elaborate a little bit on that. So, as we price out loans, and, I get phone calls daily, what's the rate today? And that's all I get. What's the rate today? Like there's just one rate. Well, sir, it's 7.25. Are you ready? No, there's a lot that goes into the pricing, the risk of the particular loan for your specific scenario. Literally, there's 20 to 30, input criteria that we must have: loan to value, loan amount, credit score, loan program, amortization term. I mean, everything makes a difference. And if we just do one slight deviation from the best of the best, it can drastically change the interest rate that's offered to you. And so, yeah, when you're calling for a rate quote, please be, prepared. We're not trying to grill you. We're just trying to ask the appropriate questions that we can provide to you an accurate rate quote. And the more information that we can gather, the more accurate. I mean, yeah, I can drive around and look on billboards and see 4.99, but what you're not seeing is the asterisk down below that is a below market rate. And that rate doesn't apply to everyone. And that rate is, because it's below market, requires discount points. So where I was kind of going with this is to explain how do lenders pay for it. It's similar, I've seen it, I hear about it once in a while, is no lender fees, no closing cost loans. Well, how do they do that? I mean, we all know nothing is for free. So what they do is they just build it into the interest rate. If the going rate is 7.25, they're going to charge you 7.99, and they'll pay the fees for that. And the same goes with what, again, Jocelyn was referring to as the lender paid premium. If you just want to increase your interest rate that's offered to you, instead of taking it as a lender credit towards closing costs or something else, we're going to pay that mortgage insurance premium. As she mentioned, in today's market, I'm pretty sure that's not utilized too much. Every dollar and cent makes a big difference. And the difference, on a $700,000 purchase in 0.75% of an actual interest rate increase, that's a couple $100 increase versus actually going the opposite way, where we can, instead of $89 of mortgage insurance, we can get that down to $35 or whatnot. So just want to be clear on how does that work and some of the terminology and details around that.
Yeah. And I also wanted to clarify, that's kind of how mortgage insurance prices out as well. We look at every single factor. I get tons of questions from clients or, consumers asking me, well, how much would my mortgage insurance be, a month on a $700,000 loan? I don't know, because we need to know details. As much as lenders need information, so do the mortgage companies.
Right.
We need to know, how much debt do you have? How much down payment are you putting down? What is your FICO score? How many bars are on that loan? If it's 2 or more, you get better premiums.
Right.
So we also need certain data to be able to establish a true payment.
Right. And with that, a lot of people, I'll be out to dinner or drinks with friends, and they'll ask, hey, what's the rate? And I'm just like, call me on Monday. Call me on Monday, because I don't even quote from the hip. It's as I tell people, it's a disservice to you. People remember what they want to remember, and if I told you 6.99 because I was indulging in a few adult beverages and having fun and just joking, you're gonna take that serious, and you're gonna remember 6.99. And so again, it's having the proper information to properly quote you. It's the best bet for everybody. So, guys, when we're out together drinking, guys and gals, don't ask me for rates, okay?
Me either.
Yeah. Now, I've got a couple questions, and I've kind of known this, and I don't know if this applies to every mortgage insurance company, but when you're pricing out a rate or a premium, one of the newer factors is DTI, debt to income ratio. And most programs like to have a 45 or below. Some will extend up to 50. There's a few that go to 55. With that, my understanding is when I'm going for a quote for MI, you look at the DTI before the MI premium. Is that correct?
Correct.
Okay. So again, just kind of making sure that we're understanding. So without MI, so principal and interest, your homeowner's insurance, and your property taxes, we can input that into the program in the fields, and that could be a 44.9. And we run it, and we get a premium that comes out to be $112. Well, that $112 kicks it over a 45, but the premium is based upon pre-PMI premium. Man, that's a tongue tire there, a little tongue twister. And so make sure that, I know that, but other people quoting you mortgage insurance, make sure that they understand that that's, as they're running the premiums to get an accurate quote for you.
Yeah, and we understand that there's changes, when a customer comes to you and you're pre-approving them. It may not be the same scenario 2, months from now when they actually get their offer accepted. So if things were to change, I always tell people, like loan officers, reach out to me because I can see if there's anything that I can do to still be able to honor that original quote.
And the quotes are important. They're numbered and labeled. It is quoting you accurately. And if premiums go up mid-transaction and I have a quote offered to me and it's accurate, that's the key thing. Yeah. It is accurate, then my quote is valid. Is that correct?
It's valid for 90 days.
Yeah. I have had instances where premiums have changed mid-transaction and I was able to obtain what was on the quote.
And that's why it pays to know who your account manager is so that you can reach out and can help.
Also your lender, one, quoting you accurately makes a big difference to make sure that the quote that we provide is legitimate and accurate for your expectations, but also valid that mid-transaction, we don't want those premiums going up any higher. If anything, we want them coming down lower. So, yeah, absolutely.
And just know if your situation does change truly and, you had to get a second vehicle for the family or whatever the case, again, you have options. So you can switch to a choice monthly and you can buy down that MI to be able to, still move forward with that loan. It's not a deal breaker.
Right.
So make sure you're working with someone that's looking at everything and every solution possible so that they can qualify you correctly and you can get into a home.
Awesome. Okay, another one. I know that Fannie Freddie guidelines for investment properties will go up to 85%. My understanding is nobody has MI above 80. Is that correct?
No,
okay.
We don't do investment properties as of right now.
Yeah.
We used to, and may come back, but as of right now, we do not insure investment properties.
So kind of what I'm alluding to is there is a disconnect between agency guidelines. There is a loan could be had if you're buying an investment property. Instead of minimum 20% down, you could do hypothetically 15. However, I'm not aware of any mortgage insurance company that will insure that. So without the mortgage insurance, then we can't offer that loan. So just wanted to verify.
And that's correct. And just to verify too, we only do residential.
Okay.
So it's 1 to 4 units.
Right. Yep.
That's when you get mortgage insurance.
Good. Okay, mortgage insurance.
And you can buy with as little as 3%. I have to make that clear because FHA, you can buy as little as 3.5%, which is great. But conventional private mortgage insurance, you can buy with as little as 3%.
Yeah, and let's talk about that. So 3%, this is a lot of times new where historically anybody could put 3% down. Now, at least one of the borrowers has to be a first-time home buyer, and you do need to take a home buyer educational course. I'm all for, right? The higher the risk, let's give you that program, but let's make you aware and just understand the full ramifications of what you're getting into. Now, with that, other 3% programs are like the Home Ready, Home Possible. It's the same concept of 3% down, but it is income if you fall within 80% of the AMI, adjusted median income, then you get a discount. And that discount extends over to mortgage insurance as well as the interest rate that's offered to you. And so any comments, feedback on that? Just kind of letting our listeners know, again, some of these cool features that those that need the help, there is help and that little extra nudge here and there to guide you.
Yes. And we work with all the down payment assistance programs.
Okay.
So if, you're doing a 3% and it has a down payment assistance program and you meet that AMI factor, we work with all of them. So we will give you a lower premium, therefore less coverage. So. And
then you call it affordable. Is that what they call the MI? Okay. So how do you look up the median incomes? You can just Google Fannie Mae Home Ready or Freddie Mac Home Possible or median income. And basically there's interactive maps that you can plug in an address or just narrow down an address. It's by neighborhood, counties, regions, and they list what's the median income, but also at 100%. But what the target here is that you're at 80% or less. They also have some additional incentives where you'll actually get paid sometimes towards closing costs if you're at 50% of the AMI or lower. The good thing is the AMI is reviewed annually, and this past year it definitely went up. I think we're up around the $100,000 range, so that's good that it's keeping up with real times and inflation and things like that. It's still translated into housing.
Yes, correct.
Cool. All right, we've got MI. I was reluctant to buy it. I'm paying $89 a month. I want that MI off. What do we do? Jocelyn, tell me, how do I get it removed?
Okay, there's 2 ways to remove mortgage insurance. I'm going to try to break it down as easy as I can. The first way is based on your original value. So whenever you purchase that property and whatever the value was at that time, that's the first caveat you need to be aware of.
Okay.
And it's basically falls under our Homeowners Protection Act. And it just states that, once you reach 80% loan to value, so your loan divided into your original value, once that accumulates to 80% loan to value, you can call your servicer and you can ask them, can I cancel mortgage insurance? If you've been on time with all your payments, if you're a good borrower and you have a good standing with them, then they should be able to remove that mortgage insurance, which can be as early as, 4 or 5 years, depending on your amortization schedule. Mm-hmm. Every time you sign loan docs, you get an amortization schedule when you're signing before you close and you get those keys to the house. And within that amortization schedule, it should have the date on when your loan is going to be at 80% loan to value and when you can call them and get that removed.
Okay.
And also on that note, again, based on original value, if you don't do anything, the Homeowners Protection Act states that once your loan reaches to 78% loan to value, so you have 22% equity, then you automatically get that MI removed. Your servicer automatically, by law, has to remove that mortgage insurance. So that's the first way that you can cancel mortgage insurance. The second is based on current value, and that's a huge topic because, like you said earlier, the values are increasing, so a lot of people that have mortgage insurance may be coming up to be able to cancel mortgage insurance. The caveat with that cancellation area is that you do have to have the loan season for 2 years. So you have to have been making payments for at least minimum of 2 years. That's Fannie, Freddie agency guidelines. You have to be making your payments on time for 2 years. And then based on your current value, if you've been at that property less than 5 years, then you have to have a 75% loan to value. That's 25% equity. So if you've built that up and you've been at the property for 2+ years and you have MI, you can call your servicer and find out if you can cancel that. If you've been at the property for over 5 years, then you are required to have 20% equity in the property. So your loan has to be at 80% based on that current value. And how you calculate that, you just simply take the loan amount and you divide that into the current value. And then you'll know what number exactly you're at. And if you have 20%, then you can request cancellation.
Perfect. Couple key takeaways. Make your payments on time.
Yes.
And that applies to just everything in credit. I can't say that enough. If you're going to pay something late, you're having hard times, drop the credit cards, do whatever you have to, but continue to make your payment. And that's something where, the importance of shelter, call your loan servicer, see if there's anything that they can work out, but continue to make your payments. And so what she's saying is you've got to have a good payment history to even be eligible to remove the PMI.
Correct.
And then there's two ways. She said it. I'm just going to say with the loan docs, as she said, in the amortization schedule, when we're signing loan docs, I go over this with the clients. You do nothing. Here is the payment number, and here is the date. All of that is right up front provided to you that you know if you did literally nothing, this is when it automatically comes off. Number two, and I've done this when I purchased my last home, a couple things. Appreciation has been good to us. Housing has been strong. This is, again, one of the many, many reasons to purchase a home and real estate in general. It's an asset that appreciates in value. You buy it for $700,000. It increases in value year over year, and with that, you can apply to have it removed sooner. And I did that. Not only was I making the appreciation was increasing, but the amortization was going down and going down at a faster rate because I was personally making extra principal payments each month. And so the amount of equity, the difference in the value versus what I owed, was growing at a very rapid rate, the combination of all that. And so I called up my loan servicer, who you make your payments to. They said, hey, it's been less than 5 years. You haven't met the 78%, so you have to do the prove it to us method. And the prove it to us is if you're applying for it sooner, then you have to pay for an appraisal. And so I knew that the value was there. It wasn't a huge risk. It wasn't a huge price, that it was worth it to me. I got the appraisal. It came back, and within a month, I had my PMI removed on my home. And that was, again, I'm not a $500 a month savings, but it was a savings that, if I think I spent $300 or $350 on an appraisal, within a few months that paid for itself. But then after that, it was just, I was saving money each month that I could put more now towards my principal than towards that premium. But again, I'm not upset I got PMI. It helped me to buy my home. And without buying that home, had I waited, the home would have cost me exponentially more. So
absolutely.
Yeah.
I mean, when I became a first-time home buyer 5 years ago, everyone was like, you're crazy. You're buying a home. And I was like, yeah. And they were like, do you have 20%? I was like, you don't need 20%. I was like, I'm buying it with 5% mortgage insurance. And they were like, okay. And now, 5 years later, I've acquired, over $200,000 in equity, and I'm due to cancel my mortgage insurance. This is on my second home.
Okay.
But I'm due to cancel my mortgage insurance next month.
Awesome.
So, I mean, I got to keep money in my pocket.
Yeah.
I got to buy that day, that year,
Right.
instead of waiting. I probably still would have been waiting to save that 20% down payment had I not taken that chance.
Absolutely. That's great. Earlier we were sharing some stats, and it was kind of astounding to me. And I was like, Jocelyn, you've got to share this with our listeners. All right, guys, let's do a drum roll. How many, let's see, they've been around 66 years. She's going to give us the numbers of how many homes and let's see. All right, what's the question? Let's start out there. How many
homes have we insured in the last 12 months?
Okay, the last 12 months. Any guesses, guys? Drop them in the comments below. What do you think? And without further ado, it is
160,152.
That's a huge number. Think about how many loans, how many new buyers. A lot of those are first-time home buyers. How many people were able to get into that new home in 12 months? 160,000 households.
Yeah. So
That's awesome.
I think last year, gosh, don't quote me exactly, but I think the average of first-time home buyers that use mortgage insurance was over 50% of the buyers in today's market.
Wow.
So,
and this is just, for reference, just MGIC. There's a lot of other companies as well. So combined, what it's really doing for the industry, that's pretty awesome. Okay, this other number is going to blow you away.
How many households have we insured since we've been in business?
So
drum roll.
66 years, how many households?
14 million.
14 million households. That's incredible. And to put that into perspective, each year, how many loans and households, how many are created is somewhere between 1 and 4 million per year. And so to have that is significant, especially out of your company, a Pioneer. I did not know that they were the originator of the mortgage insurance. So big up on you, MGIC. But they're helping people. And that's what's really cool to know is how, this is something that's essential to a lot of mortgages that we originate. Instead of being fearful of it or cringe at the additional cost, I think we should all be thankful of the opportunity that we have to get you into a home now versus waiting later. And again, that, the cost of waiting, it is significant. We can run reports. If you want to challenge me of, hey, I want to save another 10% to get to 20% down, let's do it. Let's even go real time. Why don't you wait an extra year and I'll buy a house now and we'll see who comes out ahead on that.
Right.
And this is all in good fun. Look, guys, I'm an advocate for home ownership. I'm not here to challenge anybody. It's just playful banter of, again, these are those tools that we have available to you to help you get into a home. So with that, I want to hear, I think we got a good understanding. There's different types of mortgage insurance. You have a few aces up your sleeve, the choice program, where it's kind of a split premium that you can control. We talked about having the mortgage insurance, how to cancel the mortgage insurance. What else you got on mortgage insurance? Anything that comes to mind that we need to know about?
Just so everybody knows, there's also a lot, like you work for APM, but there's also a lot of lenders and credit unions that have the capability, because they have the capital, to create portfolio products. Mm-hmm. And so in today's market, you may want to do your research to see who has a portfolio product that has lower mortgage insurance, because at the end of the day, we're a risk-based company and we can tailor certain loan programs to be less costly. So there's a lot of lenders that we work with, banks, credit unions that we work with, where we do have products that have a lower mortgage insurance. So just do your research, like who you work with matters at the end of the day. Yeah. But also if, you have a specific scenario where you just need to have a lower payment, there may be some other banks out there that have a product that works for you, because mortgage insurance, we can customize it, and that's only through portfolio lending.
Do you find, and I'm just being honest, in today's market, and I'm going to elaborate what portfolio is, do you find that there's many companies still doing portfolio products?
Yeah.
Is it mostly credit unions?
Mm-hmm.
Yeah. So here's, and I'm going to kind of rewind here back to the foreclosure crisis. It was the perfect storm. It's not just one thing. It was the collapse of the banking system, right? So they didn't have enough capital to support it. But then you also had banks left and right creating their own programs. And when you do that, you portfolio it, meaning you don't sell that loan. It stays on your books. Think about that. That could stay on your books for a 30-year loan, could be up to 30 years. And so good or bad, that can be challenging. And what happened was the capital requirements were low. Banks started getting into where bad loans, and this was where creative underwriting, stated income loans, stated income 80-20, meaning 100% loans, were popping up, and they were starting to default left and right. And so banks had to reach into their pockets to start either repaying and buying back loans, or they had to just cover their own losses to stay afloat. And unfortunately, that sank some ships really, really fast. And so the concept, and this is the reality, is the federal government came in to save the mortgage industry. You might not like that concept, but I'm going to tell you, without that, our GDP, our global domestic economy would have collapsed without that. Housing is 25% or greater of the GDP. And so we need that to be thriving. We need that for homeowners to go to Home Depot and Lowe's and do home improvements. So the government came in and bailed out some of the banks, and they also took them under conservatorship. And that was where they had to change the guidelines. And we came out with things like a QM, or qualified mortgage. I think it was all for the greater good of the economy and for the overall system. The financial requirements are much more rigid today of what they were back then. They should probably even be higher. I don't know. It's, we only test these when times are tough, right? Because when times are good, everybody's doing well. When times are challenging, this is where, and we are seeing this now, times are, with rates higher, we're seeing acquisition after acquisition, banks being bought out by other banks. A lot of that is occurring, and it's a lot because of the capital requirements of what it takes between capital and regulations. This is not an easy industry, and it needs to be here. We need to have lenders providing homeownership and housing and whatnot. And so, again, kind of where I was just, inquiring on the portfolio stuff, the way that loans are now is if you do a conventional loan, it is ultimately underwritten across the board. It doesn't matter if you're with American Pacific Mortgage, Rocket Mortgage, United Wholesale, whatever company you want, is we follow the same guidelines of either Fannie or Freddie. So this does a lot of things. It standardizes mortgages. That, again, competition is there, but a lot of it is just on the pricing, and there's really not a huge difference in a lot of the pricing, but it's making the products that the consumer can go to any one of us and know that there's not going to be any surprises or anything. It's standardized. It also makes it that when we do a loan, we sell that directly to Fannie Mae, whether we retain the servicing or sell the servicing. Where does that come into play is, again, the capital requirements, the reserve requirements that we have to have. If and when times are tough, we can sell that loan. We can free up capital. And so it's an integral part of how the mortgages are done. Now, I find this with credit unions. Credit unions are the exception because they're customer owned in essence. When you're a member, you're actually part of that. Your funds are used towards that. Credit unions have, and I do see portfolio products. They do not sell them. They originate them for them. But here's also the reality, is they are extremely conservative. That means strict. That means they will decline your ass really quickly if you don't meet this very, very small box. I've had a local realtor that I've worked with, and when it was time to purchase their home, they came to me and said, "Hey, do you have this product?" I said, "No, I do not." They said, "Okay, we're gonna go with this credit union." Hey, I respect that. Thank you for the opportunity. If that doesn't work out, please keep me in mind. It was 2 days later, they got a decline. The program didn't work. It is so strict because they have to be strict. It is their performance that it has to be a win. It has to be, if it's not 100% performance on that loan, it needs to be a 99% performance. They don't have this 5 or 10% margin of error to spend their clients' money. And so, again, these are those rare exceptions that you do see is with credit unions, if it fits the shoe. Where I see it, this is another one, is right now the market is inverse for a 30-year fixed versus an ARM. And historically, when times get tougher and rates go up higher, what happens is instead of taking a 7.25 30-year fixed, we look at an adjustable mortgage. It's a 30-year loan, could be fixed for 5 years, so you still have the stability, but then we're able to offer a lower rate. And right now, the shorter term loans are much higher rates than the long term, and it's backwards. But that's the way that every single lender prices out, except I see a few credit unions that are willing to say, you know what, this is the industry and this is where going rates are, but are we willing to turn down a 6% or 6.5% 5-year ARM they're willing to get a little creative in some of those options. So, I'd say it's less than 1% of the loans that I see out there, but there are a few creative credit unions. With creativity sometimes brings risk. So I think it's, I'm not saying don't go with them. If there's an opportunity for some type of savings, look into it. But also look into who you're doing business with.
Absolutely.
Yeah. Again, one of my tangents. I go off my little tangents just talking about home ownership, and I get all fired up for it. So
I did a quick example here. We have a buy now versus wait calculator. That,
okay.
You had mentioned how, you should buy today because it's going to cost you more.
Yes.
This is a very simple example, a $540,000 purchase price. And they can buy with as little as 3% down today. And their potential PITI would be about $4,000. Or they can continue waiting and they would potentially lose almost $1 million in home appreciation. And if they continue paying rent, I just based it off of maybe they are paying, $1,300 rent, which that's not accurate.
Where's that?
Yeah, exactly. They would, it's going to be double, if anything. They would have lost over $367,000 in rents.
Wow.
And their future payment, if they continue waiting, which will take them 18 years to save a 20% down payment, then they would be looking at a payment of $6,000.
Wow.
Yeah.
Yeah. Yeah, we have a lot of those calculators, the cost of waiting, and they're, sometimes you just don't want to you want to disbelieve, oh, those numbers aren't real, but they are, folks. Mm-hmm. Just go back a few years and talk to your friends of, what did they pay for their home and whatnot. And, hey, I'm not going to say every year is a golden year that we're going to have 10% appreciation, but I will say over the last 90 some years that we've been tracking it, it's pretty much an even keel of about 5% year over year. Some years are great, some are down a little bit, but the number that are down, and this is what's really interesting is, I have this chart, and over the last 90 years, and this includes the Great Recession, the housing foreclosure crisis, some other little, recessionary things. How many years do you think the appreciation or housing values have declined? Jocelyn, you got a guess? Of 90 years, how many years do you think decline?
I don't know.
6 years, folks. So the odds of all these people, they're my neighbor's cousin's brother that tells you that there's a bubble and a housing crisis coming up. Let's result to history. Let's result to the resources here and available that show us otherwise. Housing is strong. Even though rates are higher right now, housing is strong. Mm-hmm. There's such a demand for it. The demand is only increasing. So yes, we can say, how long can this go? But at the same time, let's look at the pattern of how many people, what is the first age that they buy? It's between 34 and 35. How many of those are coming into age right now? It's only increasing.
Yes.
It's going to push demand even further. And so, talk to experts about this, have them show you the data. It's not my opinion. I have beliefs, but my beliefs are data driven. That's where I come from, is I let the numbers do the talking.
Oh yeah. And I just saw a statistic not so long ago about first-time home buyers. 82% of first-time home buyers are under the age of 40.
Yeah.
So, and it starts from age 25 to 40. Right. So, there's people buying homes.
Oh, absolutely. At any rate, people will buy homes. Now, what goes away are the refinances. But here's the other staggering thing. Whether you want to refinance or not, and we're seeing this where people are getting very stubborn, they don't want to touch their first mortgage. We are at an all-time high of credit card debt. How much is on the credit cards is at an all-time high. Those rates, the overall rate industry predicated by the Federal Reserve, has been going up over the last few years. It used to be maybe 14, 15%. They're talking now that the average credit card rate is 25%. Now, they've put a hold because of COVID on student loans. Those are now kicking in September, and the payments are going to be back in October. So we have credit card debt at an all-time high because people want to continue living this lifestyle. We want to go out to dinner. We're trying not to embrace a new budget, right? Of, well, I used to have $500 a month, but now everything's costing $1,000 a month. Instead of putting yourself on a budget, which we should all be on, and I'm going to raise my hand. I am on a budget. My family's on a budget. We really, it's
You have to be.
things are good, but it's also living within your means. And I'm not saying things don't pop up. This week we had to take our older dog to the vet. That was unexpected expense, cost $600 of shots and medicines and things like that. Things do come up. And that's where, thankfully, cash reserves, savings accounts, credit cards are there to save it. But with that, we're seeing an incredible number of people humbly come to us. And let's not focus on the rate per se. Let's look at the actual consolidation and how this can help you and your family. I recently had one where they were carrying $108,000 of credit card debt.
Oh my gosh.
And they didn't want to get rid of their low interest rate first. And I said, I can save you almost $2,000 a month by consolidating. If you don't look at the numbers, you're still focused on what this interest rate is. You're doing your family disservice, and that's unfortunate. And that savings was based upon minimum payments on credit cards. That's not even paying it down. Now we can consolidate it into your mortgage. You have some mortgage write-offs. You're applying principal as well as interest. So
You have room to breathe now.
exactly. So
And same thing goes for buyers that are looking to buy a home today. Don't get so fixed on the interest rate.
Yeah.
Like your rent is 100% interest rate. You get nothing of that.
Exactly.
Versus taking a 7% interest rate in today's market, which is not even, 100% accurate. You can always refinance out of that interest rate in years to come.
And here's the other thing. Let's say you do have 20% down. Awesome. What if you save 10% of that, put 10% down, you did an MI buyout or single premium, the proper terminology here, and then you use the other 10% for home improvement. Now you got the kitchen for your wife that she always wanted, and you're going to get your return on investment for some of those things like that, where you can have, even though the mortgage is a little bit more, it's a write-off up to a certain dollar amount, and so you're able to write off the property taxes, the mortgage interest, I believe in some cases even the mortgage insurance. So there's a lot of different options out there for you guys. I really loved having this conversation. Jocelyn, you've been amazing to kind of enlighten me, kind of get me all inspired. And now I'm a big fan of MGIC, the pioneers here. So is there anything else, PMI, MI, that we have not covered that you'd like to throw out there?
No, I think we covered it all. I just, want everyone to know that it's not a scary thing. You don't need 20%. It is a strategy, and it's super affordable to be able to get into a home with mortgage insurance. So don't shy away from it.
Awesome. Thank you again for your time. Hey, I appreciate all of you listening. Trusted me when it comes to topics on mortgages and real estate. This is G Money, real talk on everything mortgages and real estate. Stay tuned for the next one. Peace.